Alright, so what actually creates a compounding business? When making decisions, most investors focus on revenue growth, earnings growth, and stock price. But those metrics are actually outputs. What really drives long-term growth actually comes down to two things: reinvestment and return on invested capital. Reinvestment rate is a portion of the company's operating profits that gets put back into the business to fund future growth. It funds things like capital expenditures, R&D, and expanding operations. Now, ROIC tells us how effectively that capital is used. In simple terms, it tells us how much profit a company generates for each dollar that it reinvests. Now, here's the thing. Both of these metrics really matter, because a business that doesn't reinvest in itself is going to eventually stagnate. On the other hand, a business that does reinvest itself but at low returns doesn't actually create value, but rather destroys it. Now, when we put both of these metrics together, we get another very important metric called structural growth. Structural growth is equal to ROIC times the reinvestment rate. And structural growth tells us how effectively management can allocate capital within the business. Ultimately, structural growth is what drives compounding value. And so that's the key lesson. We're capital allocators, and so we want to invest in businesses that are just as good at allocating capital as we are. Because ultimately, good capital allocation is how long-term value is created.